I'd like to start, reminding everybody of a message I've given before, but I think it's super important. And it's the idea that at the end of the day, a portfolio is a team, and you and your capacity of CIO or investor are really the coach. We have a range of internal and external strategies and managers, which are just pieces of that team, of that portfolio. And the rules of the game are simple. It's all really about capital preservation. In order to win, you must first not lose. And without capital preservation, in my view, there's nothing, because if you lose 90%, it's going to take you about 100 years just to to compound your way back to par. So in that sense, as you know, the presentation will be structured in 4 parts as usual. We'll talk about the strategy, how it fits within the portfolio. We'll talk about the macro outlook, and we'll have some Q&A. And in terms of the performance and the strategy, quite a remarkable month after perhaps one of the most hostile time we've seen in a long time, definitely since 2008 and probably beyond. We've seen 2 months now of very, very strong recovery and bounce, with the S&P now over 40% of the lows, and quite remarkably, strategy like Igneo has been holding its capital and even making some money. So plus 1.2 in April and plus 4.4 in May. It is quite a tough June so far, but I think it's very much in line with the objectives of capital preservation and generating these large returns during hostile markets. Looking at the absolute return profile, we continue to have quite remarkable numbers. I mean, this is close to 50% year to date, over close to 35% annualized. And but beyond the absolute return, obviously we talked about relative returns. This is people tend to use Sharpe ratio or information ratio as the return per unit of volatility. And using the average volatility, as I explained before, is fine. You prefer a manager that makes 20% with 10 vol than 20% with 20 vol. But average volatility works when you're looking at symmetrical distributions. Be careful, because there's lots of cases where somebody might have a reasonable high Sharpe, and all it is hiding a lot of risk inside. And we've seen many of those instances happening in March and February. And therefore, this asymmetry, what we want is the other side. We want situations where we're skewed to the upside, and that will be better reflected through a Sortino. So it's not just about average volatility, it's about obviously good volatility and bad volatility. And as I always say, nobody really called to complain when we made 16.5% in August or 19.1 in March. It's more about that downside. And here we continue to produce quite extraordinary Sortinos. So altogether, high absolute return, risk adjusted, and very asymmetric payout, which makes the strategy a good player for the team. But perhaps what is more important, or in my view, is when these returns happen as well. And what you see here is an updated hostile market analysis. You see in orange the S&P ranked from worst to best, and you see that Igneo has performed very strongly, very consistently, with a correlation of -1. So each and every single time that the opponents were shooting, we were doing saves, and in fact we've been generating bigger returns than the losses on the other side. It's also very remarkable how this has happened, with more benign bullish markets. And again, April 2020, best month since 1987, we were up, and also recently in May. This is not just against the S&P. In fact, this is something that we've done against pretty much every other. If you picked the Spanish IBEX or emerging markets or high yield, what you see very clearly is this concept that I've talked over and over again, which is the idea of false diversification. You could have a basket of, you know, US equities and Spanish equities and high yield and EM and think you're diversified, and the reality is that when things go wrong, you have just one trade. And if you were fooled by that false diversification and you were caught with leverage, you may have been stopped out of these positions, which is a shame. So in that sense, we differentiate between this idea of false diversification and more true diversification, which is something that you achieve by construction. It's not something that just happens by fluke. It's something you build and aim for. In that sense, we have you know, the objectives of the strategy, as you know, are in this order: capital preservation, are large absolute returns during hostile markets, and neutral to positive carry and expectancy. This is what we set up to do in previous presentations, and that's me with a beard last month in the Morgan Stanley conference. Same place, same tie. It's basically, I discuss in a lot of detail the strategy. So there's a 30-minute discussion on the presentation itself, and you should have a link to that in your in your email. So I encourage you, for those that are keen to look in a lot of detail into the strategy, to go through this this video. And today I will just run through some of the key components a bit faster. And as you know, the strategy has these three core building blocks across precious metals, treasuries, and insurance, where very importantly, there's no leverage, there's no shorts. So the precious metals and treasuries are aiming to be rolling synthetic calls that give you superior returns and enhance capital preservation. But the area that really stands out and has been responsible for the explosive payouts is the insurance program. And this insurance program, as you know, has one key characteristic, which is we only buy options. We only buy options because for many reasons. But as I always say, I saw a guy in my career with $1 million of VAR lose 50. So when you buy options with 100% certainty, you know your downside. And effectively, this allows us to sleep at night, to live through, and as a goalkeeper, ensure that we survive. Now, there are two main uses for these options. We could either buy put options on risk assets, such as equities, credit, high yield, EM, commodities, or we could also be buying call options on anti-bubble, anti-crisis, such as gold, treasuries, the VIX, or the dollar. So this gives us a very diversified program with no shorts. You had a snapshot of what the portfolio looked like at the end of February. At that point, we were the best performing hedge fund in the world, and we had about 23.8 at risk, which was effectively split into calls and puts throughout time, throughout different pairs, throughout different payoffs, strikes, etc. A very, very diversified portfolio that actually set the scene into March, which was a phenomenal month, where we were probably, if not the best, one of the best performers. And remarkably, we did that in a very consistent manner, even when gold and treasuries core components were collapsing along with bonds, as people like Ray Dalio and risk parity were getting destroyed through the high correlations and volatility. So what happened, and this is important, is of course we have a very eventful month. You know, some parts of the portfolio made money, such as treasuries. Some parts of the portfolio lost money, such as gold. Some of the options, which were relatively small bets, paid many multiples. We talked about in detail about the calls on the VIX in a previous call, or the contingency, dollar S&P puts contingent of the dollar. And this gives you effectively large gains that we crystallize into capital. So for us, profits become capital, and the red becomes yellow, blue, and green. So more gold, treasuries, and insurance. This is effectively reinvested in a forward-looking basis. So the fact that you made money on the VIX doesn't mean you should be reinvesting in the VIX. At that point, we found opportunities on the yuan or gold or others, and this is done very dynamically. What it means in practice is that, you know, when the dust settles and as we continue to do this, you know, you go back to a more neutral position. So yes, those of you who've been invested with us at the beginning of the year had $100, now they're 150, but the risk is pretty much identical. So we have a very smooth profile, which means that the strategy is doing what it says in the tin. This is the best feedback I could get and I've been receiving. And by the way, this is the probably the biggest sin any manager could have, which is to say you're going to do one thing and then do something else. And we've seen CTAs and others that have been positioning themselves as defenders being completely on the wrong side and being taken out max long at the time when the market retraces. This gives us also a very smooth risk profile, which means the strategy, whether you entered 2 years ago or 2 months ago or 2 days ago, it gives us a similar profile. And it's forward looking. I'm a chess player, I'm a contrarian. So we're looking for the areas where we will find the next 10 to 1, not where it was necessarily last month. Very repeatable, scalable process, and also very important with daily liquidity. So this week, one of our investors was not very happy because they were invested in a tail risk fund, a competitor. They've been in the trade for 10 years, underwater. Suddenly they were kind of back to where they started, and then they couldn't get out. They had to give like a month's notice, so opportunities were missed. So I think here daily liquidity also is relevant and is something we support. With that, let's get into where we are today. The portfolio, as you can see, is changed. There's options that perhaps have expired, others that you know we've taken profits, and other positions where we are adding in new positions. We've also grown the AUM, therefore we're also growing the option program. And you see also that whilst the overall risk profile, a risk, you know, about 25.8% at risk on the option program throughout the next 30 years, it's also interesting to see how this has changed a bit. So an area like the S&P has lost a little bit of through mark to market, although those options are still alive. And then we've seen the gold component increasing, both because we've done new allocations as well as mark to market. So as you look through 2020, we have about 6.5% at risk from mark to market now, which is, you know, a little bit more on the S&P than gold. As you move into 2021, we start to have more views on rates and dollar and gold. And as you go beyond that, you start to see more rates and Vega with gold and also rates and treasuries. I will highlight an interesting trade, and this is part of the education of how some of the options can allow us to achieve our objective of low premium, explosive payout, and basically very good carry. And this is a trade where it combines two of our core views, which is it's a 3-year option. We're bullish. We think gold will do well over the 3 years. Don't know over the next 3 days, but I have a high conviction over the next 3 years for sure. And similarly for the yuan, which is under increasing pressure, and we think it's, as we'll discuss later. So the question is, I could buy a 3-year gold call for about 17%. It's neither cheap nor explosive, and it has very negative carry. Or I could be buying put options on the yuan at about 7%, which again, it's quite a big number. It's a break even. So by effectively structuring this as a worst off, so we will receive the worst performer of the gold call or the dollar China call, which is a put on the yuan. We're able to cheapen this to about 2.6%. So we've bought $300 million of this trade, and it's a trade that will perform, in my view, very well under multiple scenarios, including one where gold does well, and effectively the put on China converges to a vanilla, which again has massive carry upside. And so we're long gold, we're short yuan, we're long gold vol, we're long FX vol, we are short in correlation, and we have potentially quite nice carry. So explosive, etc. So this is one example I'd like to highlight, and it goes back into our view of major themes that are both risks for the economy and opportunities for us to generate these large multiples when you need them the most. At the end of the day, as you know, the strategy is not really a black box. It's not, many of you can look at the screen and know that perhaps yesterday was not a great day with gold down and equities up and gold down and the dollar, etc. And this predictability is something that we take pride of, and the question is, how asymmetric can we do this thing? So yes, we have these core views on gold and treasuries and vol and correlation, just like equities or credit or China or the dollar. With that, I'm going to move into just a brief update at the portfolio level, and here again, looking at the team, and I like to pair Igneo with the S&P, and I do it with 50-50 weights, and some people think it's very aggressive. The reality, as we've discussed before, is not really. In fact, in some of your cases, whether you're an advisor or a family, there are multiple cases where the wealth of the family, the non-financial portfolio, whether it's an operating business, hotels, or a company, at the end of the day, that more illiquid, non-financial wealth is a striker. You will do well and you will make money if the world is a great place. And I think COVID has been an obvious example of that. So in that sense, the financial portfolio is there to offset this and create more defense. So my view is that in many cases, financial portfolios and the liquid financial portfolio that you manage should be pretty much biased to defenders and goalkeepers. And I don't really see the point of having a real estate developer buying into high yield, for example. If you want to take risk, take it on your own. So in that sense, this mindset of strikers is very entrenched. But when you build a team, and you look at what happens is, this is a 50-50 basket. So, someone has $100 and it gives $50 to brother A and brother B, and they both go on their own ways and do their stuff. So obviously the return of the basket is the average of the returns. But what happens is the negative correlation means that we do this with a very, very low drawdown and volatility. So when you think about it in risk-adjusted returns, it's much better to have the team that either potentially of the individual components. Now, the profile is so extraordinary that we could do what I call smart leverage. And smart leverage is, well, if we had given $80 to each, effectively what you see is that the risk profile is marginally higher, but the return is 1.6 times higher. And this is powerful, but it gets better because, and this is a key concept I want to reiterate today. And it's basically back on the view of, 2 months ago, it was the end of the world, and today it's nothing happened, right? You could be fighting the stupidity of the market. You could be fighting the irrationality of the market, either way, by being stubbornly, on one side or stubbornly on the other. And you are losing sleep and stressing out and trying to pick the timing when the world is much easier. Because if you have a balanced basket, what you do is you embrace the stupidity of the market. Oh, you want to pay 3,400 for the S&P? Here's a little bit, and I buy more of my goalkeepers. Then the other way around, the market is giving you the S&P at 2,200. Perhaps you should be buying some of that and rebalancing. This rebalancing process, which is really some element of mean reversion on the long term, effectively taking advantage of the volatility and irrationality of the market, would have regenerated about 10% incremental. Just purely by sleeping at night, you made an extra 10%. You're not fighting, oh my God, the S&P, this is impossible. And many people I'm speaking to just talk about, oh my God, we don't understand anything. There's 40 million unemployed. And so that irrationality, if you fight it, is pretty dangerous, especially when you have the central bank on the other side. But trusting that central bank put blindly can be equally, if not more painful. So in that sense, what we see, and in fact, in a meeting today, it's interesting because one of the clients said, I want to buy this. So we might have instead of just buying the pieces, somebody wants to buy it all in one piece. So if that might be of interest, let me know. I'm totally indifferent, but we may just package something with this 80/80 and monthly or price target rebalancing. Now, on that basis, again, the team and the power of the team is way superior to the individual pieces, and that becomes clear here when we go back to the original building blocks, and you see that the 80/80 team would have done better than either one in every single respect. Absolute return, drawdown, volatility, risk-adjusted, and you have just some extraordinarily off-the-chart risk-adjusted return and asymmetry. So this is the beauty of finding true diversification, and the challenge, of course, is how do we ensure that your strikers score and your goalkeepers save. And in our case, this is really what we try to do, and again, the pieces are there to hopefully deliver. So with that, I'm going to move to perhaps what most of you are interested, which is the kind of discussion on the market and the outlook. And I would like to reiterate the three tectonic forces that I believe are at play. The first one is the one that the damage was already done, in my view. So prior to COVID, we had a situation where the last 10 years have been what I would describe in one sentence as the transformation of risk-free interest into interest-free risk. We saw how the 10-year bond went from 5% to 30-year bonds at negative nominal yields. This is just how artificially low interest rates have effectively distorted valuations and created a series of global parallel synchronous bubbles that are just too big to fail. So this delicate situation, we had a glimpse in Q4 2018 of the issues we would face if we tried to normalize, which was obviously off the table, and then central banks shifted into do whatever it takes to prevent those bubbles from imploding. Unfortunately, we are still experiencing the biggest shock, or one of the biggest shocks we've experienced, which is still being resolved, and lots of questions, which we'll discuss in a minute. And then, of course, we've had a monetary and fiscal response without precedents. And just a few minutes ago, we had the ECB delivering yet another bazooka into the process in what feels like monetary and fiscal without limits. So with that, there's a lot of questions, but I think we are in a new paradigm shift, and the next 10 years will be very different from the past 10 years. And in my opinion, if I had to summarize this in one sentence, would be the transformation of bubbles that are too big to fail into inflation. And let's look through some of the key questions that we're finding from a macro perspective. Are we looking at temporary or permanent damage? Not long ago, we're talking about depression. Now looks like nothing's happened. Can we solve solvency with liquidity? I talk about inflation, but probably short term we'll see deflation. What's happening? The disconnection between the real economy and financial markets. Is this a bear market rally we should be selling into or not? Is this just a normalization? The differentials between fundamentals and positioning. Is volatility at a new normal? Will we converge? How about MMT and the possibility of normalization and globalization versus protectionism? Is this over? These are all questions that we are, I'll share my views. It's obviously a very dynamic world. And I'd like to focus specifically on this issue of how markets and the economy seem to be dislocated, and the impact of monetary policy and fiscal without limits. So let's look at the shock that we were going through, and we start with the volatility shock. We saw the VIX trading to levels we hadn't seen since 2008. And this created a wave of forced liquidation, of course, and across the board. April and May, we've seen that volatility selling off to about 30, which is elevated, but we also see it, quite reasonably high, and also realized volatility is actually keeping a bid on volatility. So my opinion is that I think volatility will remain elevated, and 30% is probably a decent anchor to which we will pivot around. We also experienced, a brutal demand shock, and many of us are still in some sort of lockdown. We've seen unemployment, going to levels we haven't seen ever, and then we've seen, gradual reopening, lots of hope, but the trend in unemployment, we'll see what happens. But the trend is increasing still, albeit at a slower pace. So mixed signals there. On the supply side, we're seeing, how the fear of supply logistical chains, obviously China at the forefront, was impacted. We haven't really seen, thankfully, physical shortages, although emerging markets are effectively starting to follow the trend. And we will see what it means, whether there's structural changes and what that impacts. We saw an energy crisis we had negative oil prices a few weeks ago, major stress across credit markets. We've seen volatility, taking a lot of people out, the ETF creating permanent loss of capital, as we discussed in a previous update. And we also see, these monetary policies without limits, even effectively providing bailouts to everybody, the airlines, the energy, whoever, more of the same. And we've seen a pretty major bounce in energy prices that, to be honest, seem to be implying that we're back to completely normal. So I would argue that the risk short term is probably skewed to lower, and there's a lot of uncertainty about Q4 and potential second wave and others. On the health side, obviously the system was caught completely off guard. A lot of economies having to make very tough choices between, the health and deaths and the economy. And we've seen, lots of rumors about, vaccine and great news, when in reality it's been 35 years we're trying to find a vaccine for HIV, or, to date, there's still not a single vaccine for any of the coronavirus, whether it's SARS or MERS or others. So it is something to be mindful of, and something we may need to learn to live with, which we're doing. And politically, of course, it's it's election year in the US. This is clearly, in my view, going to have a toll on China, and this is a dynamic that we're starting to see. So it's a source of volatility around the year end, and we'll see how it plays out. Just looking graphically at the volatility and kind of how vicious it's happened, and this bubble anti-bubble relationship between prices and vol, and we'll see. I think as I said earlier, we might be on for a higher vol. I think it's much more unlikely that, given the outlook, we'll have a return to that sort of 10 level of VIX. So let's see how that plays out, and the impact it has, of course, on risk. So with that, unemployment keeps going. We'll see, where it stops and at what point we can revert. We see lots of economic numbers. We just saw Lagarde talking about pretty shocking numbers. So after the positive initial response following the ECB bazooka, she delivered some pretty ugly perspective, where it's about 8% or so contraction in Europe in 2020, which will be +5 and +3 in 2021, 2022. So we're really looking at 2023 before we go back to pre-COVID levels in Europe, which is not great news. But on the other hand, it's coming with MMT and monetary policy without limits. So in that sense, we've seen the whole arsenal of zero rates, QE, negative rates, buying credit, buying equity, helicopter money, putting checks in people's, currency wars. And this is really something that, I believe, this is not really solving problems. It's clearly delaying, transferring, transforming, and enlarging these problems, but it's certainly not solving the problem. So this is something to be very, very mindful about. It goes hand in hand, obviously, with currency wars, a lot of cynical behavior by many governments who, behind lots of domestic policies, that are also very focused on competitive devaluations. This is the name of the game and will continue for a while. And we've also seen the fiscal side with government spending, government debt, cutting taxes. So this is like a miracle, right? I can I can basically increase my spending and my debt and reduce taxes, which is basically, and bail everybody out, by the way, because I have this modern monetary theory, which is also known as MMT or the magic money tree. And we've seen now in Europe, for example, the European Recovery Fund, which has 750 billion of combination of grants and loans, which is just more of the same. This is something that it's only possible because the central bank is printing money and the left pocket is lending the right pocket. So, within this framework, we have, and as a mirror image of currency wars, we have trade wars, which I think will remain a big issue. And this whole dynamic of what Larry Summers called a long time ago, the prudent imprudence of increasing debt. And I think we are experiencing, Powell delivered his own version of whatever it takes very forcefully, and the market continues to believe in the central bank put and how printing and borrowing and spending can actually solve problems, or at least just follow the Fed, don't fight it, and there's even ETFs that buy the basket of the Fed purchase. So there's a lot of free riding, but let's not fool ourselves. Everything that's happening, the PP in Europe, the European Recovery Fund, everything that we're seeing is there only because we're trying to avoid the collapse of the system. And this is the reality. We're in a situation where by its own weight, the whole thing would implode. And as a result, we're really looking at the desperation of central banks and governments, hoping to keep this thing afloat. So it's pretty clear to me that this ends with inflation, most likely stagflation. Those of you from Latin America or other parts have a head start on many of us because you've seen this, unfortunately, and suffered these dynamics in your own. But for many of us, is a first off, and we are living under this fallacy that and this change in the rule of the games, the rules of the game rather, that are telling us that inflation is our friend, right? In fact, the enemy is deflation, and this point I discussed before on the frog in the boiling water of being diluted at 2%. We have clearly lost independence of central banks, who are now just printing their to support the government function. This is true around the world. So we've seen, of course, many deflationary forces. Whether it's technology, demographics, or the bubbles themselves and unemployment. But let's not fool ourselves. The inflation is really a monetary phenomenon. So it's at the end of the day, it's not, as I explained later, it's not really about, inflation is not really about the value of your house going up or the value of bread going up. Inflation is about the value of the money that you use to buy that house or that bread going down. And in a world where we're literally printing trillions of dollars left, right, and center in every single country, this is something that is manifesting itself. So the rules of the game have changed. It used to be that once upon a time, if you had inflation fears, you would hike interest rates and bonds would go down. My view is you will have both inflation and zero interest rates. So we are going into a world of very negative real yields, and this is a widowmaker. I think lots of people say, "Hey, Diego, inflation is coming. I'm going to short the long bond," and boom, they're taken out. So let's see what happens. This is obviously kicking the problem down the can, and in the short term we are facing deflationary issues, let alone inflation. So people are complacently, and central banks are abusing their position to implement measures that, in my view, are easy to put in, and they're sold as emergency measures. We saw the PEP, which was meant to be a pandemic response, already expanded to 2021, June, and you will probably see PEP 2 and 3 or whatever, because this is always the same. You introduce these measures as temporary, they become permanent. You do them as unconventional becomes conventional. This is over and over the same movies, just bigger and bigger. So we're facing these bubbles that are too big to fail, and we just need to be mindful about that. So we talked at length about gold in the previous one, and how this is likely to perform well. We talked at length about China and how why I think it's the biggest bubble in financial history, and how the yuan will be the channel by which it implodes. And as I said the other day in a tweet, someone said, "Oh, China just injected $7 billion into the banks," and I said, "Not really." They didn't. They injected 50 billion yuan. Of course, they can print as many yuan as they want. They can inject those yuans into the banks, and they can print that money and lend it to everybody. But you don't need to be a genius to realize that that's going to lead to inflation and bubbles and currency devaluation. So in that sense, to summarize the macro view and the next decade, I think a global recession is very likely. I think that liquidity and debt alone will not solve solvency necessarily. I do think the virus will eventually go, but the liquidity will stay. I would be very wary because artificial valuations do not last forever, especially when we're talking about a lot of leverage and hidden leverage in the system. Yes, we might have deflation in the short term, but the bigger that is, the more inflation, stagflation we'll have in the future. I do believe that in the meantime, volatility is going to remain quite elevated, and that higher interest rates is science fiction. It's just not a possibility. So that leaves us probably with equal or lower or even negative rates. I think currency wars will continue to be the name of the game, where gold wins the race hands down, and China and others lose. And I think that leaves the question of the dollar, which I think overall, and despite the dramatic efforts by the US to devalue the dollar by doing everything they can, it's been mirrored by pretty much the same thing by every other central bank, including BOJ, ECB, SMB, BOV, and the whole list. And then on the trade wars, I do think that we will see some changes. The reliance on China as the unique provider of certain things is proven to show a bottleneck in the system, and I do think that China will be a major loser. With that, and before I open up to questions, some big picture implications in this sort of new world. And I think when you build your team, the other day I did some interviews this week with Grant Williams and Keith McCullough at HI, and I published an article also on the Wall Street Journal on inflation. And it was funny because I introduced this idea of defenders and strikers or goalkeepers, right? And the idea of a team. And it was funny because a lot of people spend their day having this fight between bulls and bears. So you spend your day, I'm bullish, I'm bearish, this is going to infinity, this is going to zero. Guys, this is like, being Real Madrid anti-Barca, or look, you can put actually a really great team together. The national team could be awesome. Just get the best bulls, just get your strikers to do their job, which is make money when you need to, do these call options, and get your defenders to save. So just build a team that is balanced and that can do both things. I think just positioning yourself as one side, as a bull or a bear, I think is very stressful, and I think is very inefficient. So I would argue that we need this. And someone was tweeting, I said, Diego, great, the market is in FOMO, in fear of missing out. What are good defenders now that the market's in FOMO? And I was saying, dude, you need the defenders at all times. When Barcelona plays a third division team, they still have a goalkeeper. They still have 4 defenders. Yes, they may win 7-0, but they don't win 7-0 just because they show up with Messi and that's it. You need strikers, midfielders, defenders, and goalkeepers, and you need them at all times. Now, how does that look like in a world where inflation might be a problem, and on a medium long term, I think those strikers should be more equities and less credit. I think the asymmetry of credit, if someone gives you back 100 euros in 10, 20, 30 years, you're not going to buy much with that. I think inflation, the purchase power, the real capacity is not there. So I would favor on the strikers equities versus credit. Hands down, I would favor real assets to cash. Cash is going to get obliterated through time, and we're going to get pinched. And then obviously, if you're looking for defenders, I call as you know, the Bund is Franz Beckenbauer, right? It was a great defender a long time ago. He's 74 years old. It's much harder for the Bund to actually protect the portfolio when it's already at negative yields. So in that sense, you need to look for defenders, whether it is more asymmetric, whether it might be gold or options or strategies like Igneo. And at the end of the day, this is a team effort. So with that,